Tomorrow at 2:30 p.m. Eastern, Kevin Warsh steps in front of a microphone for the very first time as Fed chair. And what he signals in the next 24 hours is going to move mortgage rates, government debt costs, and Bitcoin. Specifically, a pathway to $160,000 that most people aren't connecting to this Fed meeting at all. Most of the financial media will spend tomorrow talking about whether the Fed cut rates or held. That's the wrong question. By the end of this video, I'm going to show you the actual framework Warsh brought into that chair. A plan that sounds completely backwards. The Fed cuts rates, your mortgage goes up, and Bitcoin gets its biggest macro catalyst of the cycle. I'm going to walk you through all of it, and at the very end, I'm going to show you the one number that ties the whole thing together. The number Warsh is actually watching that almost nobody in the media is reporting. Stay with me. Let's start with the number that's probably already making your stomach drop. May 2026 inflation came in at 4.2% year over year. That is the highest CPI print we've seen since April of 2023. And if you're watching this, you already feel it. Groceries, gas, insurance, everything is more expensive than it was 2 years ago. Now here's the problem for the Fed. They have a mandate, 2% inflation. They're at 4.2%. That's more than double their target. So conventional wisdom says, you can't possibly cut rates right now. Cutting rates when inflation is this high would be like pouring gasoline on a fire. And that's what everyone in the financial media said yesterday. But let me ask you something. What if 4.2% is the wrong number? What if the way we've been measuring inflation, the way we've been measuring it for decades, is actually capturing things that the Fed has almost no power to fix? Look at this breakdown. Energy is up 23.5% year over year. That's not the Fed's fault. That's geopolitics. That's oil supply. The Fed cannot drill more oil by raising rates. They cannot sanction a country out of a production cut by holding rates at 3.75%. And shelter, which includes rent and something called owner's equivalent rent, that's up 3.4% year over year. Housing costs make up about 26% of everything in the CPI basket. That one component alone adds almost a full percentage point to that 4.2% headline. So strip out energy, which the Fed can't control. Strip out the categories that are being pulled by extreme outliers on both ends, and you get a very different picture. Because there's a measure, a specific tool that Warsh has been publicly referencing. It gives you a fundamentally different view of where underlying inflation actually is. And when you see that number and understand what it means for Fed policy, the rate cut everyone's been waiting for suddenly looks a lot closer than 4.2% would suggest. Here's the number. Trimmed mean CPI, 2.3%. Now what is that? A trimmed mean inflation gauge does something simple. It strips the outliers. The biggest price increases and the biggest price decreases get removed. And what you're left with is the core of underlying inflation. What's actually happening in the middle of the distribution, where most of the economy lives. Warsh, who spent years at the Fed as a governor before Trump nominated him as chair, has been on record saying he prefers these alternative measures. Why? Because they tell you what monetary policy can actually affect. Not energy shocks, not post-pandemic housing distortions. When you use trimmed mean, you're already basically at the Fed's 2% target, or close enough that you can make a credible case for easing. So why doesn't the Fed just cut and call it a day? Because the CPI headline is still 4.2%. And the moment Warsh steps to that podium and signals a rate cut, every financial commentator in America is going to say, the Fed just blinked. Inflation is at 4.2% and they're cutting. They've lost control. So Warsh needs cover. He needs a framework that lets him cut rates while simultaneously keeping inflation from reaccelerating, especially in housing. And this is where the plan gets interesting. We're about halfway through. Everything so far has been the why. The next section is the how. The actual mechanism Warsh is building. Why it's designed to keep your mortgage rate elevated even after they cut, and what it means for the government's $36 trillion debt problem. That's where the real story is. The Fed currently holds roughly $2 trillion in mortgage-backed securities. These are bonds backed by home loans. They've been slowly letting them roll off. That's called quantitative tightening, or QT. But the pace has been slow. Here's the framework that Warsh is building. And this is what nobody in the mainstream media is connecting. Step 1. Cut the federal funds rate. That's the short-term rate. Markets cheer. Headlines say, Fed cuts. Step 2. Simultaneously, accelerate the selling of MBS. Dump mortgage-backed securities into the market. More supply of MBS means lower prices on those bonds. Lower bond prices means higher yields. Higher yields on mortgage bonds means higher mortgage rates. You see what's happening? The short-term rate goes down, which is what Trump wants, because the government has to refinance trillions in short-term debt. But mortgage rates stay elevated, which keeps demand in the housing market suppressed, which keeps shelter CPI contained, which gives Warsh the political and statistical cover to say inflation is under control. Look, I want to make this crystal clear, because this is the part that directly affects you. If you own a home, your equity isn't going anywhere fast, because mortgage rates staying high means fewer buyers can afford to enter the market. If you're trying to buy a home, don't expect relief from a Fed rate cut. This framework is specifically designed to decouple those two rates. The Fed can cut, and your mortgage rate stays at 6%, 6.5%. That's the intended outcome. Now, if you want to actually see this decoupling in real time, the spread between what the Fed is doing and what your mortgage rate is doing, I built a tracker for exactly that at timtalksfinance.com. It's free. You can see at a glance whether the gap between Fed policy and your mortgage rate is widening or closing. Link is in the description. And if you're in the market trying to figure out how bonds and equities react to a rate cut, you need to understand that this isn't a traditional rate cut cycle. The mechanism is fundamentally different. Now, here's who actually wins when this plays out. Because when you follow the money through this entire chain, there's one asset that has historically benefited more than any other. And the data behind it is not an opinion. It's a 0.85 correlation over 5 years. Let's follow the money. The US government has over $36 trillion in debt. A significant chunk of that needs to be refinanced in the next 12 to 24 months. Short-term treasury rates are closely tied to the federal funds rate. When the Fed cuts, even by a quarter point, the government saves billions of dollars in interest payments. This is not a conspiracy. This is arithmetic. And it's why there's been enormous political pressure on the Fed from the White House to ease. Interest on the national debt is already running over $1 trillion a year. Every quarter point cut matters. So when you wonder why the Trump administration is pushing for lower rates, even when CPI is at 4.2%, that's your answer. The government is the largest borrower in the world. They benefit from lower short-term rates more than anyone. So the QT for cuts framework serves two masters at once. It gives the government cheaper debt refinancing, and it gives the Fed a credible argument that they're still fighting inflation by actively removing MBS from the system. Now, here's where this gets into territory that financial news is not connecting. When the US cuts rates, it weakens the dollar. A weaker dollar makes dollar-denominated assets cheaper for foreign buyers. And other central banks, looking at a weakening dollar, start to ease their own monetary policy to stay competitive. That's called global monetary expansion. Global M2, the total measure of money in circulation worldwide, has a 0.85 historical correlation with Bitcoin. Not 0.5, not a loose relationship. 0.85 over 5 years. That is one of the tightest macro correlations in all of financial markets. Right now, global M2 growth turned negative earlier in 2026. That's part of why Bitcoin went from $90,000 in November 2025 to where it is today, $66,449 as I'm recording this. But here's the inflection point. The moment the Fed signals a cut, the moment global liquidity starts to expand again, that correlation flips. Global M2 goes up, Bitcoin follows. That's not speculation. That's the historical pattern. Raoul Pal, who runs Real Vision and has been one of the more accurate macro forecasters on Bitcoin cycles, has been tracking what he calls the 5-year liquidity cycle. His framework, based on institutional adoption, the halving cycle, and global M2 expansion, points to Bitcoin in the range of $160,000 before this cycle closes. I'm not telling you that's a guarantee. I'm telling you that's what the macro backdrop looks like when you connect these dots. So here's the signal. Here's what to actually watch after tomorrow's press conference. Because it's not the rate decision, it's the language. And I'm going to tell you exactly what to listen for. Tomorrow, 2:30 p.m. Eastern, Warsh takes the podium. Here's what matters, and here's what I told you I'd deliver at the start of this video. Almost no one in the financial media is going to be asking about the framework. They're going to ask about the rate decision, which is almost certain to be a hold. Futures markets are pricing in a 97% probability of no change tomorrow. That's not the story. The signal is in 3 specific things to listen for in the press conference. Signal 1. Does Warsh reference alternative inflation measures? If he mentions trimmed mean, median CPI, or talks about underlying inflation dynamics being well contained, that is him laying the groundwork. He's signaling that the framework exists. He's telling the market, we have a different way of seeing this. Signal 2. Does he mention MBS in the context of QT pace? If Warsh says the Fed is considering accelerating the pace of MBS roll-off or active sales while holding rates, that's the QT for cuts framework being deployed in real time. Most anchors won't flag this as a rate cut signal, but it is. Signal 3. Does he mention the global backdrop? Any language around global monetary conditions, dollar strength, or international coordination is a tell that the Fed is watching global liquidity, which directly feeds into the Bitcoin thesis I laid out. And now for the thing I promised you at the start, this chart. The divergence between trimmed mean CPI and headline CPI is the widest it's been since this inflation cycle started. When headline CPI ran at 9% in 2022, the trimmed mean was also elevated. The inflation was broad-based across almost every category. Today, the trimmed mean sits at 2.3%. Headline is at 4.2%. That 1.9 percentage point gap tells you the inflation we're seeing right now is being driven by a small number of extreme outliers, energy and shelter, not broad-based price pressure across the economy. That's the argument Warsh has been building. That's the intellectual cover for the cut. And that is what nobody in the financial media is explaining right now. Here's the bottom line. The Fed meeting tomorrow isn't about whether they cut or hold. It's about whether Kevin Warsh signals the framework he's been building. A plan to cut short-term rates for the government's benefit, while using MBS sales to keep mortgage rates elevated so housing inflation doesn't reaccelerate and give him political cover to ease. If that framework gets confirmed, even subtly, global liquidity expands. And if history rhymes, Bitcoin at $66,000 today is not the price you'll be talking about at the end of this cycle. Before you go, if today's video changed how you're thinking about rates, don't just move on. Head to timtalksfinance.com and grab the rate tracker I mentioned. It's free, it's updated, and it'll tell you exactly what to watch for as this plays out. 2 minutes. Links in the description. I've also linked a breakdown of the trimmed mean inflation data in the description below, worth 10 minutes of your time if you want to go deeper on why this measure matters. Next video, I'm breaking down what happened after the press conference, the market reaction, the bond market signal, and whether the QT for cuts framework showed up in Warsh's language. If you want that breakdown the moment it drops, subscribe. I publish these as fast as the data moves. Hit subscribe, and I'll see you in the next one.